Hello everybody and welcome to a new video. So this video is simply entitled me paying attention to mostly new stocks, although you'll see some of these stocks I've covered on the channel. I'm thinking especially of StoneCo, which I've covered many times. But I've been doing some screening of stocks recently because I've had new money come in with the sale of a house, and I'm trying to diversify a little bit for my he must do something portfolio. And if Tesla bounces back, I might actually move away from buying Tesla and actually move into other stocks, although I've been buying Tesla a lot lately. With that drop, it's still my number one position. But I think it's important to have a little bit of diversification. And there's a lot of very interesting companies out there that have stunning numbers. And today, I want to use my expanded spreadsheet. So I'm still going to use my spreadsheet where I look at enterprise value over gross profit over revenue growth. So EV over GP over RG, what this means is how much am I paying for that growth? And I want those stocks to be cheap. I want to pay as little as possible for each percentage point of future growth. And when you look at those numbers, you see that my average is a 0.18 out of all of the stocks that I present to you today. So that would be in the top 20% cheapest in my universe for all of these stocks. All of these stocks are stocks that I would consider to be quite cheap when you look at how much growth they have. And look, that makes sense. If you look at a company like, even a company that has, say, a enterprise value over sales or a ratio of 10 or 15, you may say, oh, it's expensive, it looks expensive, but look at the growth rate. 79% next 12 months, 122% next 12 months. That means that ratio is going to be close to a 6 12 years from now, right, in the case of Transmedics. So these companies all grow extremely fast, except Inmode. But Inmode, I believe the growth will come back because that's one of these companies that has been impacted mostly by the interest rate environment. Like for many of the stocks on my channel, they've been kind of hurt by the interest rate environment. Anyways, I use that. So I use EV over GP over RG, which is my historic metric for this channel. And I've added recently EBITDA margin. EBITDA margin is, to me, that's the true economic power of the firm. How much money the firm actually makes today, how much money they actually make now. So you take your total revenue, you multiply it by EBITDA margin, and you should be extremely close to the free cash flow number. It's a metric that has the advantage to not suffer as much from any special item, the EBITDA margin. So I use EBITDA margin as an indication of how profitable is a business, knowing that none of these businesses are mature. So for every single business you look at, I believe that EBITDA margin should still increase because all of these businesses are investing in their growth. And even if you look at companies in the payment sector, like a StoneCo, for example, at 42%, which is my highest EBITDA margin, I believe this can increase. They're still investing heavily in their growth. And if you look at how much, say, a Visa earns in terms of EBITDA margin, it's much closer to 60%. I believe that can get to these levels over time. So absolutely outstandingly profitable companies. And if you look at my average rule of 40 metrics, so if you add EBITDA margin to revenue growth, you add both of them, I get an average on all these stocks of a 76. I get an average of a 76 with all of these stocks but one being above a 50 and a bunch of them being 60, 80, and even 100. So that number, if you're interested in both balancing growth and profits, the profits that they make today, if you're interested in both profitability and profit, if you look at this number, to me, it's very mind-blowing for all this set of stocks. So let me just get started. Talk to you about each stock, as I always do, why I like the stock. So the first stock that I want to talk about is Oddity. Oddity is an Israeli company operating in the US, and they have these new brands that are driven by social media and by big data. They use big data to create brands that are extremely compelling to mostly young female millennials in the United States, mostly. And they have two brands. One of them is called Il Maquillage. Il Maquillage, from what I understand, is an app. You scan your face, it will give you a foundation with a perfect color for your skin. And that's, if you look at their reviews, if you look at Il Maquillage reviews, are almost a 5 out of 5 everywhere. It's pretty impressive, and it's pretty impressive how many followers they have on Instagram and all of these social media. And if you look at their other brand, Spoiled Child, that's a brand of anti-aging lotions for your skin, for your face, for your hair, related to collagen and anti-aging, dermatology-based type products, but of course not medical products. And it's the same pattern as their first brand, Il Maquillage, growing very, very fast. So when I look at a company like Oddity, who for now has 2 brands, but who specializes in big data and using data to create new brands, and they have two more products coming, which we don't know what they're going to be, but they're working on 2 more products. What that tells me when I look at Oddity is I'm getting a company at a 0.14 on my metrics, so extremely cheap, less than 5 times sales. Revenue growth next 12 months is predicted to be 46%, high gross margin at 70%, and already EBITDA margin profitable, so that's a 66%. Oddity is benefiting from the end of legacy brand when it comes like legacy retail brands sold in stores, because Oddity, of course, is not selling its brands in stores, it's selling them online, and I believe this brand to be very, very compelling. My only downside for Oddity is that it's not available among all brokers. It's still a pretty low spread stock, if that makes sense, as opposed to widespread. It's not not a lot of people own that stock, and so it tends to be more volatile, and it's kind of a newer issue, and that comes with those issues, with the issues typically associated with lower issue, which is, typically you can't borrow against them, you can't do margin. Many brokers don't have a stock like Oddity. Nonetheless, I like the stock. The stock is cheap right now because it got hurt because of the Israeli Palestinian conflict. That's why it got hurt. A lot of people are saying, well, it's going to be hurt because of that, because it's located in Israel. But anyways, that's just to me, that's temporary things. To me, these things are going to get back to normal, and this Israeli company will get back to their premium, in my view. And it's funny that I mentioned that, because Inmode is the same situation. Inmode is a stock that has gone down, in my view, a little bit because of the Israeli conflict, but also because of the way this product is sold. So what is Inmode? Really briefly, Inmode is a medical device for skin tightening. It's a hybrid between very expensive cosmetic surgery like a liposuction, and between light procedures like a laser-based weight loss product. So it's kind of a hybrid product. You can do this in an office, in a beauty office, if that makes some sense. You don't have to go to a surgeon. And they sell these machines that have all of these different skin tightening technologies. The business right now, the money that they make is still based on the sale of the machines. And these machines cost, 60 to 100 grand per machine. That's the cost of one of these machines. And right now, of course, the sales of those machines is down, and that's why it's predicted to grow only at 12%. So why is it down? Because interest rates are pretty high. These machines get financed at interest rates similar to personal loans, personal rates. And so doctors are hesitant borrowing at 9 to 10%, $70,000 to buy a machine. That's why the sales of these products have been down. Same situation, say, for the automobile industry, right? Tesla is going for the same period. Same for Enphase with the solar industry going for the same period. When you sell, items $50,000, $60,000, and you have to get them financed, the interest rates are really, really hurting you. That's why I think the growth will come back. But despite that, they've held strong on their margins. If you look at Inmode, the margin are still 84%, which is stunning. And if you look at that EBITDA margin, this is my second highest EBITDA margin in my spreadsheet at 41%. So even with 12% growth, I still achieve more than a rule of 50. Which is stunning. So this stock could have no growth at all, and you would be at a rule of 41. So that's absolutely stunning. And of course, my metric here, a 0.25, it's actually a very good score to be a 0.25 on this metric. But compared to a few other stocks that I have today, it looks expensive, right? But it's actually not. It's actually more than 3 times cheaper than, say, a Tesla. But the reason why this number seems a little high relative to the other ones is because it's only growing at 12%, only predicted to grow at 12%. In my view, the growth will pick back up longer term at much higher levels, and as a result of that, the EV over GP over RG should actually be much cheaper. This metric really penalizes quote-unquote low growth stocks, like a stock growing at 12 to 15%. That metric is going to penalize it. Nonetheless, I think it's a very compelling stock, and I own it, and I'm happy to be buying more at this time. The first stock that I want to start a position on, I still don't own it, but I want to start a position on it, is On Holdings, Onon, ticker symbol Onon, but it's On Running. The name actually comes from their shoe sole technology called On Cloud Tech, and of course they are one of many running shoes and tennis shoes brand that claims to have the best technology. There's other brands out there that claim that. They all make that claim. The point is, for me, is I see this company as being the high grower. If you look at a company like Nike, it's only growing at the rate of the economy. If you look at a company like On, it's growing at 51%. They are clearly resonating with their customers. They have a community-driven selling technique. They sell a lot through these community stores that they put in major downtowns of major cities, and they sell a lot through word of mouth. They are a more premium shoe than your average shoe. And I've made a full video about 4 days ago on going into more detail as to what this company is all about. The growth, 51%, is stunning. It's a company that is EBITDA margin positive, profitable at 11%. So if you add both 51 and 11, you get a rule of 62 as far as that growth goes, and it is dirt cheap at a 0.14. So that's a stock that I'm happy to own. One more thing about On that is very interesting is there's a few catalysts coming. One of the catalysts is the Olympics in Paris, where they're hoping to have tons of promotions going, and another catalyst is, to me, the ownership structure of On, which makes it very unlikely for this company to be acquired and makes it much more likely for this company's managers to run the company for decades to come. They've set it up in a way, they've built it in a way that this is a company that can last decades and not a random SPAC, and I do believe the management team appears to be on a mission, and it's a fairly inspirational company the more I look into it, and I am looking to pull the trigger on this company. Let's talk about Clear, ticker symbol U. So Clear Secure. What is Clear? Well, if you live in the United States, you may have seen it all over airports. In airports, you have TSA pre oftentimes, but you also have this other setup called Clear. It's actually very interesting why Clear is picking up. Clear is picking up because TSA pre is overwhelmed. So you have people who travel so much that they even can't do the line of TSA pre, and so they decide to go to the line of Clear. Clear is your face as an ID. You register your face with their system, and your face becomes your ID. And then you can get this system, get these Clear booths to get quicker to your destination. You get quicker through the security line at the airport, but they are obviously trying to not be just an airport company. They're trying to expand beyond that, and they're trying to do business with hospitals, with stadiums, with big corporations in big buildings. And, you know, instead of having to show your ID whenever you go somewhere, you just show your face, you're recognized, you can enter, you save a lot of money on the security officer who in the past had to be the person checking your ID. I like this company because it's dirt cheap, trading at a 2.42 enterprise value over sales, 2.4x. So that's pretty cheap. And if I look at my metric here, you can see the second cheapest stock of all the stocks that I show you today. It is the second cheapest at a 0.089. So barely more expensive than StoneCo, which I'll get to in a second. It's still predicted to go at 43%. The gross margin is excellent at 63%. And of course, this is a company that's scaling, that's ramping. So the EBITDA margin right now is negative 2%. So I penalized them, and I removed that. I removed that little bit of a loss. But even if I remove that little bit of a loss to a 43%, I get a 41. I still get a rule of 40 on this stock, knowing that these early growth companies, of course, their EBITDA margin ramps. You know, your EBITDA margin usually when you begin business, starts at a minus 30, minus 25%. And then all quarter after quarter, many years after many years, you gain a few percent points on your margins. And eventually, after a few years, it becomes positive. This is a company whose EBITDA margin is about to become positive, at least over the next year. So this is a very compelling stock in my view. And I like that space. I have no exposure to that space. And I think it could be a big idea. Moving on to Shockwavve, ticker symbol SWAV. So Shockwavve Medical is a stock where, quite frankly, I'm attracted by these metrics. Of growth and EBITDA margin. Quickly, what is Shockwavve? Shockwavve focuses on one of the types of atherosclerosis, one of the side issues of atherosclerosis, which is calcium deposits. What SWAV does, Shockwavve, is they use sound waves in order to break calcium deposits inside veins and arteries, and it's a very innovative product in that very very niche of healthcare, but it's really not that much of a niche, knowing that, of course, heart disease and blood circulation issues is the number one cause of medical troubles in America and in the West in general, right? Heart issues, blood issues are the biggest issues. So they're addressing a major problem. It's a worldwide problem. This is a company that has a lot of opportunity. For example, they're waiting to enter China. China right now is going for an anti-corruption campaign, but they're hoping China will be a major market for them with the aging population of China. They are entering Europe. They are present in many markets in the US, and it is a technology that has many better outcomes than current existing technologies, which with existing technology are more mechanical breakage process where you blow a balloon in people's veins, which really is not as good. Anyways, very specific stock in a very specific industry. But look at those numbers once again. Look at the rule that I get. It's rule of 83, and to me that's a very good diversifier type stock. And I want to say, as an aside, whether it's for Shockwavve Medical or for Transmedics, when I get to Transmedics, these two stocks don't tend to not have the volatility and the stigma associated with former SPACs. As you see, many of the stocks I show you here are former SPACs, and I think we're still on the tail end, towards the very end of these issues of the SPAC association with the bubbles. I like that companies like SWAV or TMDX don't have those associations, and that's a stock that I own. I'm happy to own it, and I think it will do well in the future. Moving on to a stock which oddly also has a rule of 80. That's StoneCo. So StoneCo is, if you watch the channel, StoneCo is no stranger to you. I've covered it many times on the channel. The stock ran a little bit, right? I mean, it's at 18-ish bucks right now. It's not as expensive as it used to be when I was covering it just 3 or 4 months ago, but I think it's still dirt cheap. It's actually still the cheapest stock I'm showing to you today. But if you add 41% revenue growth, which is what analysts predict, and I know in the comments people tell me that's not true, they only go 12%. Well, I am sorry, but the number that I'm looking at is not 12%. The number that I'm looking at is 41%. That's what I find when I aggregate all of the numbers of the analysts. This is not a typo. That's what I find. So maybe the analysts are wrong. I don't know. In my view, they will grow well above 30%. In fact, based on my analysis of StoneCo and my analysis of the last call and the investor day, in my view, StoneCo should do 45% next 12 months. That's what I put here. Now, of course, I reuse the analyst number for the sake of consistency here, but in my view, they could do a 45%. Anyways, if it's more than 30%, it'll be outstanding. Look at that gross margin, 74%. EBITDA margin is a 42%. So you get a rule of 80, a rule of 83. So that's quite stunning. And StoneCo, if you're new to the channel, what does StoneCo do? StoneCo is the square terminal payments of Brazil. Brazil has 3 million small businesses. They have way more small businesses than many countries, and these terminals are getting adopted by medium-sized businesses, small stores, small restaurants, small sandwich shop, etc. They're getting adopted to pay, and that's really the square of Brazil is the way to talk about it. And they have major expansion plans in so many different areas. Moving on to Celsius. Celsius is also a stock that I sold sold for a profit, and I'm looking to get back in. And the drop in that stock right now, for me, in my view, is an opportunity to get back into Celsius. Celsius is predicted to grow at 79%. The gross margin is excellent at 48%. For a beverage company, that's downright excellent. Keep in mind, they have to move that drink. They have to move the drink for trucks, for distribution. And they have a partnership with Pepsi now. So their partnership with Pepsi is one of the reasons why they're going to be able to scale. There's major catalysts for Celsius. The first catalyst is taking market share away from more quote-unquote mainly marketing. I'm going to call it mainly marketing type beverages like a Monster or a Red Bull, where you show extreme sports to sell energy drinks. Celsius is an energy drink just like those two, but it's not using extreme sports to sell the energy drink. It's not showing something extreme. It's using more of a holistic, general, fit / health marketing. And I realize this is all marketing. Beverages are all about marketing. The marketing of a company like Celsius is much milder. It's a less quote unquote hardcore marketing. It's more of a marketing that's appealing to a wider range of ages, to both genders, and to different times of the day. In the US, how many times do you go to a gas station in the morning, 6 a.m. on a road trip, and you see people picking up a Celsius at 7 a.m. That's something that I think a Monster beverage hasn't been able to achieve. You don't see a lot of people picking up a Monster at 7 a.m., but you see people picking up a Celsius instead of picking up a coffee at 7 a.m. And of course, it's a company that's inscribing itself within the broader disruption of coffee as the energy commodity, the energy drink commodity of reference that everybody tries to take market share since the beginning of time has always been coffee, right? Even Coca-Cola, you look at Coca-Cola, technically it's an energy drink, right? Coca-Cola has 35 milligrams of caffeine. Celsius has much higher contents of caffeine. Therefore, it makes the product addictive. People go back to it. People love their caffeine, and that's why that growth is so big. And it's a 95%. So we're almost at a rule of 100 here at a 95%. If I add 79% growth plus 16% of economic return that we're already making, I'm at a 95%, which is amazing. And let me conclude with the last stock, a stock that I have started buying and that I am adding to right now. And I've changed my mind. This is a stock where my first video I was pretty negative in this stock because I was not very comfortable with organ donations. And, I didn't know much. And I had an initial rejection on the idea of a company doing that. But after listening to many calls from TMDX, I do believe they're addressing a real needs. They're disrupting the use of dry ice to transport organs from donors whenever you have a tragic accident, a road accident, and it's a tragedy and somebody passes away. That person goes to the hospital. And then if that person is an organ donor, you're going to have a surgeon who's going to say, take the heart, right? Or take the lungs. And these organs are going to be put in their system, which is the organ care system, which is a system that they're created to have organs last longer and last in a controlled environment. And it's much, 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 much better than dry ice, because the problem with the legacy technique of dry ice is that you get way lower outcomes and you end up losing many, many, many more organs on dry ice. And Transmedics changes that, and it changes that in another way. This is a company that's gotten under a little bit of flack for buying its own airline. They bought a flight school, and they are shutting down the flight school, and they're getting all of the small planes, and they are now operating their own airline to transport organs. And why would they want to do that? Because as they explain very clearly on the call, right, dry organs on dry ice cannot be transported through commercial routes. So they have to bid on private aircrafts. They have to bid on aircrafts. And that means that multiple days out of the week, they are not the highest bidder on these aircrafts. So in the legacy system of organ transplant, there's days where you simply can't get an aircraft to move your organs. You know, the CEO it was very interesting. Like if you talk in the US, whenever you have a sporting event, and it doesn't have to be the Super Bowl or the World Series, even minor sporting events, sometimes you can't get a jet. You can't hire a jet to move organs. You can't do that because it's of course offered to the highest bidder, and the highest bidder is typically some rich guy or girl who wants to end up watching a football game. And so there's plenty of days in the US where private jets are simply not available. You simply can't book them, and it's not like you can book an organ transplant trip in advance. It's not possible to book that in advance because you never know when the business comes, right? You know it literally a few hours before. So there's plenty of days where they can't book those flights to move those organs from the place where the donor is to the place where the recipient is. So there's a lot of tremendous advantages to this technology. Another advantage is the fact that since the organ can stay within the system, within the organ care system longer, since the organ can stay longer, then surgeons are more likely to engage in the surgery because you have more time possible for the surgeon to organize their trip to the place where the surgery is going to be performed, and you can do it within the hours of the day, and you don't have to necessarily do it at night. It really revolutionizes that world of organ transplants. And so even though maybe, I do believe over the long term, like over a very long term, stem cells, over a very long term, growing organs, mechanical organs over a very long term, I believe could be a threat to this business, but for the foreseeable future, I think this could be a very, very interesting business. And is it going to be like, can a mechanical organ, when we get to that level, can they ever be as good as an organic organ? Well, we'll see. I'm not a doctor in that field, so I wouldn't be able to tell you, but we'll see. Nonetheless, I think the market doesn't lie. The market doesn't lie. And when you're a business who they were growing almost 170% over the past 4 quarters, now they're growing at 120%. I mean, you still have some triple-digit growth ahead. I would say 2024 will be a triple-digit growth, and 2025 will likely be a triple-digit growth for them if you just take your average rate of deceleration. And then in 26 or 27, maybe they'll be at 79, 80, and maybe then they'll be at 60%. But the growth doesn't abate that quickly when you have a business that has this much inertia. This is a business that has tremendous inertia. I own the stock. I want to own more of this stock. So I hope you found this video interesting. I'm still very busy at the moment. I am looking to get back to my regular daily schedule of video, but unfortunately life has been extremely hectic right now. So, but I'll get back to it, and thank you for watching. No investment advice, no financial advice. It's always just entertainment. I appreciate your likes. I appreciate your subscribes. Thanks again for watching, and have a wonderful day.